Good morning, guys. Happy Friday out there. We are getting started on a little bit of a live stream here on Rogue Macro. Make sure you guys like and follow for more of these. I will be going regularly live here, and we're going to go over the macro market and stuff like that. This is what you're seeing right here is roguemacro.substack.com. Go there, sign up, at least to get the free blog, but there's also paid versions. I've been writing for a long time in Bitcoin and macro, and so this is a new publication that's going to be concentrated just on the macro portion of my content. So check out roguemacro.substack.com. This was a piece that I just put out 2 days ago. It was paywalled, but now I just put it public because I want to talk about it. There are a few things coming out of China today, and so I wanted to walk through a few of those and talk about this liquidity and everything. So let me make sure I'm on the right screen, and I will bounce into this post. So this post originally came from talking about Bitcoin cycles, but I take a look at the copper to gold ratio, take a look at PMIs. So this is really a macro focused post, but trying to explain this weird market that we're seeing. I have a discussion here about liquidity. We're not going to go over that. PMIs, you can see this black line right here, the PMI cycle. This is the business cycle. If it's above this black line, then it is expansion. And if it's below, it's contraction and in recession. Well, we've had this very weird period here going back to 2022 almost. It looks like halfway through 2022, we went negative. It is 33 out of 35 months negative on the PMI, manufacturing PMI for the United States. And we are not in recession, which is really weird. You can tell this is a change in the business cycle, which it's hard to explain. So this is why I'm kind of trying to explain it and showing Bitcoin here in orange, also in a weird straight line formation. So I dive into the Russell 2000 correlations, what we're seeing, and we're seeing the Russell 2000 here in this black line breaking out of consolidation. You can see just the last couple ticks here, last couple days are above this line, and the Russell 2000, which is a small cap index in the United States, kind of a broad measure of economic activity, and it is breaking out higher, which is really weird if we're seeing these low PMIs, right? It doesn't quite fit. Copper to gold ratio. This is a long-term trend downward. Ever since the great financial crisis, we've been in this long downward trend. And if gold is outperforming copper, that signifies a weakness in the market. You can see during these gray shaded bands, these are recession bands, and the copper to gold ratio really dives during recessions typically. And that's because copper is bid when the economy is expanding and construction is going crazy. You need copper for pretty much anything modern, including houses and electronics and all of these things. And so copper will be bid when the economy is expanding. Gold will be bid relative to copper when there is uncertainty and there's bad economic times. So this should fall in bad economic times. Well, what does a decade-long trend of slow grind lower mean? It means that we've kind of been in a very recessionary, maybe a long silent depression, people have called it, for a long period of time. So that's what this copper to gold ratio. And since we are dipping, that doesn't match the Russell 2000. So going right back up here to the Russell 2000, it was breaking out, which is a positive sign for the U.S. economy. But copper to gold is dipping, which is a negative sign. So what is going on here? Zooming out, so let's see. That was the Bitcoin stuff. Now, conclusion, someone on the Telegram community, which you guys should join if you're watching there on Rogue Macro on X. The Telegram community is a shared community with my Bitcoin community, but it's, we talk about Bitcoin and macro all day long, and it's free to sign up. So check that out. Link should be in my bio. Larry Jr., longtime member, he pointed out that copper to gold is a global market, while US PMI and the Russell 2000 are US only indicators. So the PMI and the Russell, they're both kind of pointing to a good times ahead expansion, where the copper to gold is pointing to bad times, right? So they kind of don't match perfectly, but we can get around this divergence, the great divergence here, if we understand we're going through a period of deglobalization. And Larry it was ahead of me on this because that is a part of my macro thesis I've been talking about for many, many years. We're going into a period of deglobalization. So we should see this great divergence between foreign economies and the U.S. economy. The U.S. economy, I've been talking about a golden age for the U.S. economy. We were really subsidizing the global economic boom that we've seen over the last 50 years in the in the world, with emerging markets, with third world countries becoming emerging markets. Subsidizing, being the consumer of last resort, having the credit markets, having all of these things, providing the stable international system in which all these other countries can join, and they can export their way to prosperity. That's what happened with Japan. That's what happened with China, to a large extent, South Korea and others. They are all export powers, and they have exported their way to prosperity in this international framework that the United States has pretty much built and backstopped. And in that time, yes, the dollar has benefited. U.S. consumers have benefited. But at the same time, we have hollowed out our manufacturing, we've hollowed out our economy and our culture to the rest of the world. And so in a period where we're going through deglobalization, the United States should, relative to the other parts of the world, should be rebuilding. This is the rebuilding time for the United States, and it's a stagnation time for the rest of the world. That's a big part of my macroeconomic thesis, and that's exactly what we're seeing here with the gold to copper to gold, and the PMIs and Russell, and why they're not really matching each other. Okay, so that was that. Let's take a look at some more China news. So share this tab. So China PMI came out for October, and you can see it was another dip. This middle line right here that might be hard to see is 50. So even though they're posting these 5% GDP numbers, which no one really believes out there, they have been negative for most of this year. And let's see if we zoom out. That 50, this is a 5-year chart now. You can see a lot of the last 5 years, they have been under 50, which is in contraction as well. So China is in contraction, and that could really be shown by this flat PMI that I showed at the beginning, why the world is not, the business cycle is not business cycling, because China is not business cycling. It is really trying to control a collapse in the Chinese economy, which their PMI is showing. Another great story here that just came out today, or another article from Bloomberg: China home sales slump deepens after easing in top cities. So if you guys know, I've been on top of this for a long time. The Chinese real estate bubble popped years ago, and with Country Garden, and what was the other green one? Evergreen and Country Garden, they popped, and they really have not recovered at all. It continues to dive down. And before the big real estate pop in China, that was like 75% of household wealth was in real estate. So you can see how if you let the real estate market crash down 40-50% from its highs, what's going to happen to your average household wealth in your country? It's going to collapse as well. And that is what we're seeing. How do you boost domestic consumption in a trade war? Well, not by letting your household wealth crash by 50%. That's not a very good way to do it. So China is running into some big problems. Let's read through a little bit of this. China's new home sales extended its slump in October despite recent easing measures introduced by major cities to revive the struggling property market. Also, when you think about this Chinese property market slump and new home sales, okay, it should instantly bring to mind the demographic crisis. Instantly. We know that it's bad in Japan. I think most people know that Japan has been struggling with this for decades. They are now losing almost 1% of their population a year. They've already aged and grown old. They're going to get older on average, but they are losing a little bit less than 1% a year of their population. China, their situation is even worse going forward. Right now, they're not losing up to 1%, but they are losing over 1 million people a year. They just have a higher starting population. And that is going to accelerate because their fertility rates are so much lower than Japan's. I think they are roughly half. So if Japan's fertility rate is 1.1, China's is roughly 0.5 to 0.6. I know in some of the big cities like Shanghai, it's 1 point or 0.5 or lower. Okay, so their population is going to collapse rapidly over the next 20 to 30 years. And so what does that mean for new home sales? It's probably never going to recover. Okay, it's not going to recover in the foreseeable future. We're talking multiple decades of extended slumps in their property market. That is what they have in store. Now, the US is also in a little bit of this trouble here, but we have an extra 20 years. Our fertility rate is still up there at 1.5, 1.6. And we've had a lot of net immigration. We'll see how that changes in the future. But we've had a lot of net immigration, and that has kept our fertility rates higher than other countries. So we are less, we have a lot longer to go until the population numbers really start affecting the US economy. But other countries, man, Germany, Italy, Spain, China, South Korea, Japan, all of these countries are really going to be hit. And these are some of the biggest economies in the world, right? We're not talking about Estonia. We're talking about Germany. We're not talking about Vietnam. We're talking about Japan. Okay, and China. These are the big boys on the block that are having these demographic problems, and their property markets are not going to rebound. So the value of new home sales from the 100 largest property companies stood at 253 billion yuan. Preliminary data from China that represents a 41.9% drop from a year earlier. I mean, it keeps dropping. If your market drops 50%, guess what? It can drop 50% the next year, 50% the next year. We've lived through this in financial markets. If your investment has dropped 90%, it can still drop another 90%. All right. There's nothing to stop it from continuing to drop. And that's what we're seeing here in the Chinese real estate market. Not good for the former largest populated country. It also snaps a brief stabilization in sales seen a month earlier. So they have been doing a lot of bazooka stimulus packages. They were doing stuff where they forced people to turn in their appliances and get new appliances. And that was all subsidized to a high degree by the government. And so they've been doing stimulus package after stimulus package, and really all they see is a brief stabilization from all of these bazookas that they have been putting out there. Of course, what do? They go out there, and instead of building houses, they build infrastructure. They build bridges to nowhere. They build all sorts of different, like airports and stuff, all this infrastructure that's never going to turn a profit. It's just a misallocation of capital, malinvestment, and it's going to come back and bite them in the end. They're actually just digging the hole deeper to recovery. The creative destruction process that eventually is going to have to happen in China is going to be that much worse because of all this malinvestment that they have over there. China's housing slump has dragged on for more than 4 years, and I've been reporting on it the entire time. With sales falling further since the second quarter, mild easing of buying restrictions in some of the biggest cities failed to revive sentiment immediately in the country's labor market, and this country's labor market is souring, hurting demand for home shopping. And like I said, their household wealth is really tied to real estate. If they're slumping 41% per year, their household wealth is also radically declining. So it doesn't really matter what you do to stimulate this mild easing of buying restrictions. Okay, it's not going to revive anything because their household wealth is collapsing. Beijing is likely to become more committed to supporting domestic demand. That they've been saying this for 10 years. So every 5 years, they put out a 5-year plan. This is what communists do. The Soviet Union did the same thing. Beijing does the same thing. Every 5 years, they put out a 5-year plan. And in that 5-year plan, for multiple periods now, has been this talk about domestic demand, domestic consumption, how to boost domestic consumption. Well, one thing you have to do is you have to get your boot off of people's necks. As a communist, you have to get your boot off of their neck, but you don't want to do that because you will lose control. See, so communists have this problem. They really cannot boost domestic demand because to do so, they have to give some of the power back to the people, and they really don't want to do that. So they're caught in this catch-22 where they can't boost domestic demand. They literally cannot do it and have their same form of government. All right. They could open up. Let's say they open up and they say, hey, we're going to have free elections. We're actually going to have some elections here in China. That's big problems. That's big problems for the Communist Party, and they are not going to do that. So they are stuck between a rock and a hard place. Policy initiatives may include central government-led destocking in the property market. They're just trying to centrally plan their way out of this, and they're going to make it worse. They're never going to recover. Okay, so that's the China stuff. Let's take a look at some of the charts. So Bitcoin had a bounce here. We'll see where this goes. I did increase my DCA, my dollar cost averaging bids here towards the bottom. I don't know if I got 107. I think I got 108, but yeah, we're having a little bit of a bounce here. We'll see how that goes. Let's go to the daily. All right, let's go into some macro stuff. Let's talk about gold. Talked about this a lot here. This red line, I didn't just draw this at the top of this tick. Okay, I drew this back here at the close, and it's actually not very perfect, but I drew this back here at this close, this being the nearest support in a big sell-off. That support did hold for a few days, but then it broke, and now it's kind of back testing. And I do expect this sell-off to continue. I think gold is way overbought. If we go to the monthly chart, we go to the monthly chart and we bring up the RSI, you can see it's still over 90 on the month. And we had to go all the way back to, let's see if the 1980 bubble has it. Yep, 1980 bubble was 91. So we had to go all the way back to January of 1980 to get the same kind of monthly candle. And you can see what happened back here. Let's just zoom in on that bubble a little bit. For gold. Huge blow off top. We kind of went back and tested some of this, the other close. So this monthly close right here in January. Let's make that a solid red line. You can see that close there in January was tested again, but that failed. And then we had this very long extended bear market in gold. I'm not saying that right now we're going to have this type of extended multi-decade bear market. I mean, this went from 80 all the way to 2006. Okay. I was buying back here. This is when I came of age, actually. And I was blessed to have a father that was a sound money person, Austrian economist type, Ron Paul supporter. But this is where I started accumulating. I graduated high school, got my first kind of job, went to college, but got my first paychecks and, was stacking all here until I found Bitcoin. But that's what happened with gold, multi-decade bear market. I don't think we're going to see something exactly like that, because I think we're going to have a change in the monetary order before that happens. But I don't expect this to continue rallying. Now, it's possible that we do get some sort of bearish divergence that forms on the monthly chart, and we do get another new high, possibly as high as 5,000, but that would be so incredibly overheated. That might lock in a multi-decade bear market. So if you don't want to see a multi-decade bear market, hope that we consolidate here in gold. Hope that it goes like this, maybe down to 3,000 over the next couple of years. And then that will be enough consolidation where it can continue higher at that point. But I think we're going to see something maybe akin back here to 2020, maybe even something like 2011, because this dropped 45% in this zone right here. So maybe we see something like that, maybe not. Maybe we just get a few years consolidation like we did post-COVID. So that's what I'm looking at for gold. Dollar. Now in this kind of the great divergence, or what was I calling it? The great, what did I call it? Let me look at this. Yeah, the great divergence. Sorry, the great divergence between the US and China, and the US and the rest of the world. We should expect the dollar to rally, right? And that's what we're seeing. A lot of people think that when you have rate cuts, you're going to have dollar weakness, because it's supposed to be easing. It's supposed to be accommodative. It's supposed to be stimulus to cut rates. Why would the dollar go up? Well, that's exactly what I called, because people don't understand what the financial system is. And if the central bank is cutting rates, that's telling people, that's sending a signal that economic activity should go higher. And what happens when economic activity goes higher? You have a higher demand for the currency. And so the dollar should go up. Last year, what we saw was the Fed pausing rate cuts. In December was their last rate cut last year. They paused in January. But the other central banks didn't. So the ECB, the Bank of Canada, the Bank of England, they all kept cutting. So what happened relative to those other currencies? The dollar weakened. Those currencies strengthened during cuts. Now we're cutting again, and they've paused. So what's going to happen? The dollar is going to strengthen. This does fit with all of that. Also, if we take a look at the U.S. 10-year, this idea of growth, growth and inflation expectations. When you cut, you expect growth. So the dollar goes up, and you should expect interest rates to go up, because interest rates go up with growth and inflation expectations. And I drew these arrows during the press conference, for when Powell, was coming out there saying that they cut and all that. Last time, it also increased slightly, the U.S. 10-year yield, after the September cut, and people were like, hey, the 10-year is rejecting the Fed cut. They're probably going to say that too. I haven't looked at what's going on X really in that regard, but they're probably saying, oh, the U.S. 10-year is rejecting the Fed rate cut. But what people don't understand is the initial reaction is an increase in growth and inflation expectations. So the long-term interest rates rise. And I said, this will go on for a little while, then it will reverse. And that's exactly what we saw intermeeting. Now with this cut 2 days ago, we saw a big bounce in the 10-year, a little bit down on the day today, but overall, since the cut, we've seen a large rise in the U.S. 10-year, which is an increase in future growth and inflation expectations. But this should also roll over as we're going into recessionary period. The international system, even though it's the great divergence and we're kind of decoupling from the rest of the world, those linkages are still there. They're not completely dead. And so they will drag us downward slightly here. I think that's going to affect the interest rates. It should continue to go down. All right. So that is the 10-year. What about oil? Oil, nothing much is happening in oil. One thing, let's bring up the 50-day moving average in blue. So you can see we rejected off the 50-day moving average. There's a lot of resistance to go higher here in oil. And if the globe is going into recession, which I'm talking about China and other economies outside of the United States, then we should expect marginal demand to be down. And that is exactly what we're seeing here. Long-term trend in oil is lower at this point. I don't see any reason right now for that to reverse. All right. And finally, let's check out the S&P 500. Opened up on the day, but it's moving down a little bit. Nothing really significant to report. A little bit of consolidation right at the all-time high. I'm bullish on stocks in the near term. We are having earnings, and that was one thing I wanted to end up the day with here, was another video about earnings, and I'm just going to make my commentary on it. So let's see. Let's go over to this. This is from Nobody Special Finance. If you guys aren't following him on YouTube, I recommend you do that. He also co-streams onto X, so you guys can check out Nobody Special Finance. But here he's talking about earnings. He's talking about AI, and I'm very bearish on AI. I think it is a bubble. However, my most recent conclusions are that this bubble has a lot further to go. It's going to drive him nuts. It's going to drive many people nuts that actually realize that this is a bubble, but it can go on a lot longer. I'm thinking it's going to go on into 2026. How far into 2026? Maybe Q1, maybe all the way to Q3. I don't know. But it does have quite a bit longer to go. Not everything will go up in a straight line, but I think this bubble is just getting going. All right. So here he's talking about Amazon and their earnings. Let's listen to this a little bit. And tell me how, well, you guys can't tell me how the volume is because I can't see what's going on over there on X. Okay, so let's play.
Amazon stock jumps 13% after earnings. Why? It's surging to a record high. These earnings were incredible. Massive beat from Amazon. Look at some of these numbers. Good God. Amazon reported better than expected earnings results, sending its shares heading for a new record high. For the September quarter, the company reported adjusted earnings per share of $1.95 compared to Wall Street's estimates of a paltry $1.57. I may have embellished a little bit there, but the numbers are accurate. The earnings included investment gains from AI startup Anthropic. Put a big fat pin in that one. We'll be back. Revenue came in at $180.2 billion, which was ahead of analysts' expectations of $177.9 billion. So big revenue beat too. Not as big as that earnings beat, though. Revenue for Amazon's closely watched cloud unit, AWS, was $33 billion versus $32.5 billion analysts' estimate. A big number, good year-over-year growth, but not much better than expected. Maybe it's getting a little bit harder to round-trip revenue. I don't know. Amazon said revenue for the current quarter would be between $206 billion to $213 billion versus $208.4 estimates. So it was a guide high. On the conference call with analysts, CEO Andy Jassy said the company has doubled AWS capacity.
So he's talking about round tripping there. And that's one thing that I've been talking about. A lot of people have been talking about where one like NVIDIA will invest $100 billion into OpenAI, and OpenAI will invest $100 billion into Microsoft, and then Microsoft will invest $100 billion, and they're all investing in each other. And so that boosts their numbers, that boosts their growth. But it's just a circle. That's what he's talking about here.
Measured by power from 2022, and is on track to double capacity again by 2027. The company now expects capital expenditures to come in at $125 billion for the full year, ahead of the current Wall Street forecast of $117.5 billion. They're increasing their capex. It expects capex to increase again next year. These two.
That's another thing with the capex, so capital expenditure, investing in future like data centers, AI, that kind of stuff. All of these guys are just exponentially running up their capital expenditure. And how long can that last? You know, it's for the last 3 years or so, it has been exponential. We're talking now in getting close to $1 trillion a year. I think this year will be, I don't know, somewhere between 600 and 800 billion. The next step is going to be over $1 trillion. And how long can that keep up when you're seeing very measly profits? We're talking profits in the $4 billion range for OpenAI. And that's just revenue. That's not profit. They were actually negative by 13 billion in the first half of the year. So they have some revenue, but they have no profits. But people are expected this capex to continue at these multi-$100 billion levels quarter after quarter after quarter. For what? In a circle jerk of pumping the whole sector higher? They have to have some revenue, and they just simply do not. This AI stuff it could be great, and a lot of people use it, and there's going to be very niche use cases for AI. I guarantee you there will be, but right now there's just no revenue in it. There's no revenue in providing it. So I think nobody special is on the same exact page as me, because this stuff is really, really starting to look like a major bubble. But like I said at the beginning of watching him, it has a lot longer to go. None of these things are really overheated yet. If you look at some of these companies on a monthly time frame or a weekly time frame, they're not super crazy extended. Okay, they can go another 6 to 12 months before they are super crazy extended, and we're in a blow off top type of situation. So this can go a lot longer.
Paragraphs. I can't help but wonder, guys, when we talk about AI, why are we always talking about it? First of all, we measure it in gigawatts, how much power it consumes. And then we talk about all of the capex, how much money we're spending. How come every time we need to measure the AI bubble, we're always using phrases that describe how much resources are being wasted on it? How come we never talk about how much money it's making? How come we never talk about how profitable it is, about all the breakthroughs it's making? Maybe that's because there ain't any. Oh, so instead we talk about how much power we're wasting and how much money is going up in smoke.
Yeah, how much investment is going in is not the proper angle to be looking at this. You need to be looking at cost versus revenue, not just cost. But that's one of my things, is that people, they I think they don't respect the exponential nature of the costs. Okay. So every year it has to go up. They're training the bigger, better model. The training is more and more expensive. Hosting is more and more expensive. Exponentially so. And look what we're getting for the hundreds of billions that have been invested. We're not getting a revolutionary breakthrough, like a general revolutionary technological breakthrough. We're getting a niche breakthrough in a few things. Like, hey, maybe some video generation, maybe some game generation. Okay. But what kind of market is that? Like, what's the total size of Hollywood? Even if AI were to take over the entire size of Hollywood, let me look for that. Let me search. Okay. The AI overview says the AI overview. It is difficult to provide a single total profit for Hollywood by year. So the US domestic cinema revenue being around 8.9 billion and studio profits are 2.3 billion. Okay, so let's just be very generous and say 10 billion. Let's say AI takes over all of Hollywood and all of movies. It's the addressable market in profit is 2 billion. And they're investing hundreds of billions. And they have to keep investing hundreds of billions because what's the lifespan of a GPU? It's not infinite. I know that. It can't be more than 5 or 10 years. So they're going to have to reinvest all of this money, hundreds of billions. And the total addressable market cap for the movie industry is $2 billion. What's the total addressable market cap of gaming? Let's see. Total profit of the video game industry. Okay, it's quite a bit bigger. They had a total revenue of approaching 200 billion. With mobile games accounting for about half of that. Very interesting. I didn't know that. The global market is projected to grow by a lot. Okay, growth rate 7%. That's total revenue. Profit margin is estimated between 17 and 22%. So say 1/5 of that. So 1/5 of that would be about 30 billion. So the addressable market cap for gaming is 30 billion in profits. So Hollywood, 2 billion, gaming, 30 billion. So we're talking about 32 billion. And what are they investing? Hundreds of billions. So see, the math doesn't work out. There's just not enough. There's not enough total addressable market to make this type of investment worth it. Back when they were investing 10 billion here and there in AI, yes, but now they're in the hundreds. Soon they'll be in the trillions. Like I said, it's exponential. So there's just not a total addressable market that's going to make up for that. There's just not.
And you can see it. You can see it in their numbers. This is why I am highly doubtful of Amazon's earnings. And we got to send it. I got to send a shout out to a couple of people. First of all, Dr. Gingerballs on X. Great name. Okay. There. Thanks for the visual, Doc. Appreciate it. By the way, Dr. G here, we'll call him. He is a fellow engineer. I've been following him for a few years. I've come to respect his opinion, especially on the AI bubble. He says nobody reads the earnings report. Amazon, from their earnings report, third quarter 2025 net income includes pre-tax gains of $9.5 billion included in non-operating income. That's from our investments in Anthropic.
All right. So there you go. That's the circle jerk here that's going on. They're claiming pre-tax. These are unrealized gains. So Anthropic maybe had another round. They raised some money at a higher valuation. And so Amazon marked up their book value of that non-operating, of that value as non-operating income of 9.5 billion. That's not real profit. That is unrealized pre-tax gains on an AI company that's being pumped up by everything else in this, that's being pumped up by their investment, Amazon's investment, by whoever else is investing in Anthropic, right? In this bubble mindset. So 9.5 is a bubble number, 9.5 billion.
Guys, understand that massive beat, that $1.95 per share versus $1.57 per share. Why? Because some greater fool somewhere paid a higher price for a chunk of Anthropic, and then Amazon goes and says, well, our equity stake in Anthropic is therefore worth more money, and we just earned an extra $9.5 billion because of it. Amazon didn't take in any money. They just wrote up the value of Anthropic, a company that burns cash like the world has never seen before outside of OpenAI, who also burns cash, and poof, earnings beat. Shout out to Dr. G, who spotted that one. I highly recommend you follow him on X. But wait, there's more. We got to talk about Mr. Ross Hendricks, another guy that I've been following for a while now. Ross, excellent job. He says, how long until the algos and Momo monkeys realize Amazon operating income was flat year over year? So let's look at this picture here. If you take away the non-operating income, the big gain from their Anthropic stake, what money did Amazon actually make? What does their earnings look like without that $9.5 billion gain from Anthropic? And Ross Hendricks zeroes in on operating income. In 2025, it was $17.422 billion. A year ago, it was $17.411 billion.
All right, this is pretty damning. If you take out their balance sheet manipulation and their different non-operating income manipulation, you get down to they barely raised any profit. I mean, it went up $11 million out of $17 billion year over year. It's just ridiculous. It's just ridiculous. All right. One last thing that I wanted to show you guys before we bounce out of here for the time being. We've already been streaming for 40 minutes. Damn. Okay, so this is Elon Musk, and he's talking here about Europe, and let's get into it. It's pretty quiet, but I'll try to be as quiet as I can so you can hear it.
I mean, you're clearly seeing a massive increase in the number of attacks in Italy and broadly in Europe. And the media, the legacy media, downplays these attacks. But the attacks, the terrorism, the killing of innocent people is rising. Every week there's more. And it's more and more. And eventually, I think we're going to see widespread slaughter in Europe. That is the trend. If you simply extrapolate the trend of what is the rate at which the terrorist attacks are occurring in Europe, and put those points, it's basically deadly attacks versus time on a graph, and extrapolate that graph, it leads to the slaughter of Europe.
All right. I mean, someone made the point that, Europe is their murder rates are a lot lower than the United States or Musk's native South Africa, which is very high murder rate down there in South Africa. And I agree with that. But I want to put this in perspective of the great divergence, the great decoupling. And that is that Europe is still going on this road. And I think the US is en route to cleaning it up with the deportations that are going on and other things. And so the US is turning the corner on this where Europe has not done so. And so they're sliding further and further into this. The longer they go, the harder it's going to be to clean it up. All right. The harder it's going to be to get back control of their countries and their economies and all of this stuff. And so that is also playing into this great divergence. So we have demographics. We have communism in China. They can't boost their domestic consumption because they'd have to give some power back to the people and have elections and those type of things. They can't do that. So they're going to answer it with more repression and more malinvestment. That's the playbook for China going forward. Europe is also facing a demographic crisis, and they are facing an immigration crisis. And so they're not handling it either of them. And it's just going to get worse. And now you look at the United States, trillions of dollars of new investment, reshoring all of this activity. It's already the capital market of the world. Our demographics are better. They're not great, but they're better. And we're handling this, the wokeness, and we're handling the immigration problem. It turns out that more than 50% of illegal immigrants are on government subsidies. And so we're trying to fix that. We're already on the road to to growth, back on the road to growth. And I think that's what we're kind of seeing in the Russell 2000 breakout. PMIs looking like they could be going positive here, maybe in this quarter or in the first half of next year, and bringing back the business cycle, at least in the United States. But yeah, I just wanted to bring your attention to all those things. Say we still have some time left on this AI bubble, and go from there. So guys, this is the kind of stuff that you can expect, unique macro analysis that you can expect here on Rogue Macro. Make sure you follow, like, and retweet this stream, and go to, let's bring this up. So we started here on roguemacro.substack.com. Go here and subscribe, at least for the free account. Like I said, I put several free posts out, and I have a paid tier as well for my spiciest intakes or insights. So, all right, guys, that is it. And I'll see you all next time.